Guys, February is here, and I just simply want to provide you with a market update. We started doing this recently to really help educate the public in terms of what's happening in the market before the media, provides their update. So what happens is we're on the front end, so we can provide you with a lot of the things that we're seeing in the market now, where the media reports the activity that's already happened 2, 3, 4 months ago. So now you have this lag of information where consumers will either be too late to make a move or maybe too early in some situations. During the COVID market, we experienced a heavy sellers market where buyers gave up all of their rights. They gave up inspections, they were writing offers above list price, whatever the case may be. In 2022, we saw the opposite occur. So buyers were receiving a lot of concessions from sellers, which was very shocking to sellers because the market shifted in a way that really put buyers in a position where it was difficult for them to buy. For a long time, even during the COVID years, we expressed that it would be very challenging to purchase a home if rates were higher. Never did we expect them to peak at in the sevens. Especially in 1 year's time, they went from 3 to 7.5% roughly. And they've come down some now, but you've got this pent up demand. We saw inventory building slightly. We are not even close to pre-COVID levels in terms of inventory. We are about 30% off. So we have a significant shortage today compared to that time frame. And what we're hoping is with rates coming down, that those sellers who have been holding on to their properties because they've locked in a pretty low interest rate, that they would be more inclined to move, and now they get a rate that's more in line with what they have currently. So if you really think about what I'm saying, it's going to make a lot of sense. But I'm going to show you the inventory levels, and then we'll go ahead and kind of explain what this means and what we can expect for the 2023 market. Okay, so this is, again, pre-COVID markets, 2018, 2019. So you can see 2018 in December, we had about 16,000 units. Compared to December of 2022, we saw a decrease of inventory of about 1,000 units in our Tampa Bay area, Tri-County area. All right. Every week, our team meets to discuss what's happening in the Treasury, so we can anticipate how the market's going to react. We saw in January the numbers decrease, and these were actually just published today. So we have 10,300 units. So if you subtract this from the December numbers, we're down another 1,250 units. Okay. Inventory is shrinking. If you take a look at the 10-year Treasury, so this is the primary driver of mortgage rates, not the federal funds rate. I understand the Fed just announced that they're going to increase the federal funds rate by 25 basis points. But what does the 10-year Treasury do? It actually moves in the opposite direction. Not always, but in this situation, it moved in the opposite direction. So what this means is this is going to make homes more affordable for all buyers. So if you have an 11 basis point decrease in your interest rates here, this is going to translate to either an eighth or a quarter point on your 30-year fixed rate mortgage, which makes prices about 2.5% more, or it gives you 2.5% more buying power. So, let's say, just to use easy numbers, if you qualified for, $300,000, you can now qualify for about 300,750, 307,000. So, it's going to really open up your opportunity to buy more homes. But when you couple that with the fact that inventory is actually decreasing, we are probably going to position ourselves for some pricing wars this year. If we can get sellers to put their homes on the market because they feel that they can get a rate that's manageable, it's not going to be in the threes, but maybe we can get something in the fives, or mid fives, there could be an opportunity for them to sell their home and someone to then buy their home. So what we can take from this is be prepared for the 2023 market. Really partner yourself with a realtor or a brokerage that really understands the fundamentals of the market to make sure that either A, you can secure the home, you can get the most money for your home, but make sure first and foremost that you have someone that has your best interest in mind. You know, your opportunity cost is what you give up for the choice that you make. And I heard someone throwing around the other day, hey, you know, I waited 2 years to buy my home. Well, let's just say that the average appreciation rate for the next 2 years is 10%, roughly. And you're buying a $500,000 home. So let's say that $500,000 home is now $550,000, or, you know, times two, you know, $600,000. Now you're paying $100,000 more for that house. And in addition to that, you've been paying $2,500 per month for your rent payment, or $3,000. So that's $30,000 a year, or times two, $60,000, or, you know, $70,000, whatever the case may be. Your rent is not always going to stay the same, but that means you are actually paying $160,000 more for the same house that you can secure today. And if you're financing with a 30-year fixed rate mortgage, you will actually have saved yourself 2 years by buying sooner rather than later. So again, our market is pretty resilient. You know, it's going to really take for you to really think about what I'm expressing here, and it will make sense. But that is the reason that if you are interested in buying a home, right now is probably going to be your best opportunity. So if you have any questions, reach out to us. Our details are below. We'll be happy to just speak with you. If you're interested in selling your home, we'll be happy to speak with you in reference to that as well. And we'll certainly give you our best advice. Thank you very much.